you are told to prepare net profit margin. That means your net profit is 102 divided by times 100. So at the end of the day, you have just like this, you have 5%. So this is not, if you want to make decisions on this, because when you analyze, you interpret, then you make decision at the end of the day. You can see that looking at this working capital, you can see that the working capital is okay, but looking at this is okay a little bit, but here it's not okay at all, because profit is there. How can you have a 5% on profit on the business? So that profit, when you make decision, is not encouraging. So you can see the lapses and weakness of the financial statement at the end of the day. So now, with the help of accounting ratio, it helps to know the weakness and the strength of the balance sheet. Then we have the current ratio, which is a current asset current liabilities. Now, looking at this, I told you the other time that how many times can your current assets cover your current liability aside from stock? Sorry, we have a less. No, sorry. So just add it. Then we have a one. Your current total current asset is 1,147,500. Then you have a current liability, which is 459,000. So current ratio is there is a mistake here. So our current ratio, looking at the formula, we have a current asset divided by current liability ratio 1. Now let us our current asset is 114,500. That means how many current assets can cover your current liability? So ratio 1. So if you divide it from the current asset, so your current asset can cover 2.5 times of your current liability at ratio 1. So looking at this, you can see that this current asset, the current ratio is encouraging, because that means the company, from this current ratio, you could be able to identify that that company is a liquid company. That means they can meet any obligations at any point in time. So then we have we have quick asset test ratio, and that is the current asset minus stock divided by current liability ratio 1. That means excluding stock. Stock is included in the current asset. Excluding stock, how many times can current asset cover current liability? That is what we are going to do here. So current asset is 5, where we have the stock of 726,750. So you divide it by your current liability, which is 59000 ratio 1. So after deducting stock there, you do the division, you have 0.9 divided by ratio 1. So if you want to make decisions based on this, you will see that it is less than 1. So your quick test is not encouraging. That means the company is holding a lot of stocks in hand, and what can they definitely affect their quick ratio, which is the liquidity ratio at the end of the day. That means if stock is excluded from current asset, the company cannot be able to meet up their current liability, which is the obligation. So here it tells us that it is not encouraging. Here they have to include stocks there. So that is that of quick ratio. Now we're talking about we are taught to calculate rate of stock turnover, and the rate of stock turnover is the cost of sales divided by average stocks. So rate of stock turnover, that is cost of stock. Yeah, so that is cost of stock, then divided by the opening stocks plus the closing stock divided by 2, and that is what we call average stock. So here we have 122,400. Just add this and divide it by 2. You have 61200. So that gives you 2 times. If you divide it, you have 2 times, and this 2 times is a rate of stock turnover. That means how many times did they sold their stock. That means it is that means how they return those stocks that have been disposed at the end of the day. So it is 2 times in a year. Then the next one we have returns on capital employed. So capital employed, and don't forget our capital employed. Before you get it, you first get our capital employed, and our capital employed is a total asset divided minus current liability. So that is the net profit divided by capital employed times 100. So your net profit is look at the net profit here, net profit. So then capital employed, that means total asset minus current asset, it will give you 1,273,500 times 100. So at the end of the day, you have 8% return on capital, and that means you get 8% on the capital you employed in a business at the end of the day. Then so that gives you want to make is not that impressive with this kind of information. So now we have the owner's equity, like I said the other time. Owner equity is the ordinary share and preference share plus the reserves. So owner equity, that's what we call equity. If they tell you what is equity, equity is share capital and reserve. So that is what we call equity. So share capital plus reserves. So and share capital, if you add it, you have 1,020,000 plus 189,750. So you have 1,209,750. So that is that on owner's equity. We still have a lot of information, but the one that can guide you is the formula. Once you have been given the formula in the question, any question that can come out which has something to do with investment, profitability, or liquidity. So we have been given the formula of which we are assist us when we are given the questions under this kind of topic. So that is that on accounting ratio, which is the analysis and interpretation of financial statement. I will be talking about the topic 2, which says regulation of capital market. Who are the commission or the institution that regulate the activity of a capital market? So we have 3. We have the Security and Exchange Commission, which is the SEC. We have a Nigerian Stock Exchange, which is the NCE, and the Abuja Stocks and Commodity Exchange, SCE. Now, what are the functions, what are the objectives, what are the advantages of these regulations? So, I will be talking about the Security and Exchange Commission, which is SEC. So, this commission regulates the activity of the Nigerian Stock Exchange. That is the responsibility of the Security and Exchange Commission. And what are the objectives that they have? The objective is to protect the investors. The investors, the potential investors who are the shareholders, who invest their capital into the business. So the objective of SEC is to protect the investor. Then the next one is develop the capital market, to make sure that the capital market is going on well, and ensure that there is a growth in the capital market. Now, what are the functions of a security exchange? Number one, we have it determines the price at which security are to be sold, volume to be sold, and the appropriate time of issue. It is decided, the price of security and the volume to be sold is decided by the Security Exchange Commission. Then the next one is its registered stock exchange and their branches. So, in as much stock exchange is under the SEC, they register them and the branches they have across the country. So that is that about the functions. That we will talk about. The third one is it protects the integrity of security market against abuse. You know.